welcome to Stockcharts TV. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Today I'm going to talk to you about the 5% collapse in the benchmark S&P 500 that we've had in just the past 7 trading sessions, what it means for the stock market right now, and the key charts and metrics to watch through the rest of this quarter and into the summer months. Possibly that's going to help us to determine how much longer the market remains vulnerable to a deeper decline and when that market decline turns into a new and much better buying opportunity. The title of today's presentation is this just a minor pullback or is it the start of a very long overdue and much bigger corrective decline? Before we begin, let's review what I talked about in my previous January 13th video for Stockcharts. The title of that video was Prepare for a Deeper Correction. A few talking points from that video were, we said that most of the upside targets that we had for the major indexes had already been met. That included targets in the NDX, which is the Nasdaq 100, in the Nasdaq Composite Index, which is the larger of the two Nasdaqs. We also said that the Asbury 6, which we're going to get to in just a minute, the Asbury 6 was red or negative, indicating that the market internals had started to weaken. And when these market internals start to turn soft, so to speak, they start to weaken, that's usually within 1 or 2 days of the S&P 500 starting a decline. And that's pretty much what happened back then. Our CEF model was another thing that we covered. We talked about XLC, which is a communications sector. It's actually communication services, I should say. We mentioned that that was the top ranked sector according to our CEF model, which is our sector rotation model, which we're going to also get to in a few minutes today. XLC proceeded to outperform SPY by 5% into the middle to latter part of February. So now that we covered what we talked about last time, let's look forward and let me show you what we are paying attention to now and what we think is important for you to pay the most attention to as we move into the spring and summer. So we're going to begin by going into the Research Center. Right now we're at asburyresearch.com. By the way, if you have any questions about what we're talking about today or what we do, the services we have for investors, all you need to do is just go here to the Contact tab and you can send us a little note and we can get back to you and we can talk offline. So let's go into the Research Center, which is the payroll for us, and we're going to go into, scroll down, we're going to get to the Asbury 6. So most of you probably, if you've been watching me online for a while, we have Asbury Research has a YouTube channel, and we have a twice monthly podcast called Following the Money. We always talk about the Asbury 6. We usually lead off with it because the Asbury 6 tells us day to day what the internal health of the stock market is. The reason we built this is because you can't tell just by looking at the S&P 500 anymore. It's too volatile. The market's up 100 today, it's down 50 tomorrow. It's very easy to get knocked off of a good idea because of all of this day-to-day gyrations, which more times than not, it's just noise that helps to get us off of our game plan. So here's the Asbury 6 here. It has been negative since February the 21st, which is exactly 1 week ago today. You could see there are 6 constituent metrics here. We've got the rate of change in the S&P. We have relative performance between stocks and bonds, asset flows, volatility, trading volume, and market breadth. So we're not just focusing on what the S&P is doing this hour or yesterday afternoon, but we're really focusing on those internal characteristics of the market that ultimately make it go up and down for more than just a couple of hours. So we avoid a lot of the noise and we get to the signal. So again, a negative bias since February the 21st. You can see all 6 of the constituents are all negative. And they all turn negative. These are the dates. Here's February 20th and February 21st. It happened very quick. It happened at the end of last week. The Asbury 6 is a daily data-driven gauge of the U.S. stock market's real internal health, according to 6 diverse metrics, which we selected by quantitative backtesting. We took basically all of my favorite tactical tools that I've used throughout my 40-year career. We started to backtest them in various sets to try to find something that would give us a comprehensive daily health check of the stock market, kind of an EKG for the market, if you will, that we do every day. This is updated every day about 2 hours after the close, and it's always available in the research center. This is where the A6 has a big advantage over looking at the stock market or watching what the S&P 500 is doing and gyrating. Again, this gives us a much more comprehensive and meaningful look at what the condition of the market is. Here are the Asbury 6's signals over the past year. You could see them here. It's active. It's a very active indicator. It's meant to be an indicator rather than a model. It typically moves about 11 times a year. By move, I mean going from green or positive to red or negative, about 11 times a year since going back to 2017. Since 2017, though, it has remained dead even with the S&P 500, but with only a 13.6% maximum top-to-down drawdown versus 34% for the S&P 500. So it's about 2/3 less of the drawdown while still being able to stay with the market. The bad part of that, if there's a bad part, is it's very active. It takes a lot of movement. We use this to tell us when we should be playing defense or looking for other indications of market weakness, or when we might be looking for opportunities like we had back here in February and in May of last year. Next thing we're going to do, we're going to go back to the research center. We're going to go to the SEAF model. It's our sector rotation model. These are kind of the two anchor models for Asbury Research. So here's SEAF. SEAF stands for Sector ETF Asset Flows. It's an acronym. SEAF is a completely data-driven sector rotation model. It was created to quantitatively identify long and overweight opportunities in U.S. market sectors by following the money as it moves around the 11 sector spiders, which we see here. Together, these are the S&P 500. So we tracked these in multiple time frames, and we came up with a mathematical algorithm, if you will, to measure the speed of money moving in and out of those 11 sectors. The sectors that have the fastest acceleration of money in have the lowest number. So you can see here, this is for the week of February the 24th, which is just this week that's ending now. You can see that the fastest money in on a trading standpoint time frame have been energy and industrials. Fastest money out during the same time frame was healthcare and consumer discretionary. XLY is consumer discretionary. And then we also do this for tactical, which is monthly, and then we do it for strategic, which is quarterly. So SEAF model is always fully invested in the market, providing investors with what we look at as a dynamic alternative to the traditional buy and hold part of a portfolio. Most investors might be tactical for part of their portfolio, and some of their portfolio they leave in the market. We use this for that purpose because we're always in the top 3 sectors where the money is going, and we're avoiding these sectors down at the bottom where the money is coming from. According to hypothetical backtesting, since the model's inception in the summer of 2018 through the end of last year, the SEAF model has significantly outperformed the S&P on an annualized basis with a little bit less downside risk. So the next thing that we want to do is we're going to look at some stock charts. That's why we're here, right? To look at some stock charts. And I've prepared some for you that I think are the most significant to be paying attention to now. So the first one we're going to just look at is just a simple chart of the S&P 500. This is the S&P 500 daily. This goes back to July of last year. A couple of big takeaways here. This green dotted line is the October 2023 uptrend line. We broke it this week. As the Asbury 6 turned to red, it turned to negative, we also broke through the 50-day moving average, which is the blue line right here at 60.02, which is now a resistance level. And we broke through the trend line that originated back in October of 2023. By the way, from October of 2022, the S&P 500 is up 75%. That's an incredible distance to go in just a little bit over 2 years. What does that mean? It means that the market is eventually going to revert back to the mean. When it does, because it's so overextended, the danger is that this little weakness that we've seen here for the past week can turn into something really significant and scary. So we're going to try to look at some charts today. They're going to tell us how to determine if this is happening. So through here, the next support level is about 1 to 2% lower. 57.73 is the low that we made at the beginning of this year, and also the 200-day moving average, 57.73 to 57.17. That's the definition by many of being major support, the 200-day moving average. If we break through there, we've got some real problems. The next chart we're going to look at is of the Nasdaq Composite Index. So there we are. So the Nasdaq Comp, as I call it, it's the bigger of the two indexes. It has more stocks in it. The Nasdaq 100 is the large cap version. Today we're looking at the Comp. And a couple of things to point out on this chart. The first one is this February 24th breakdown right here. I'm pointing to it from this couple of months of sideways indecision. The market typically moves in trend, and then it moves sideways for a while to digest those moves higher, or that particular move higher. That's what happened here. The fact that we broke down through the bottom of this investor indecision area and didn't move higher to resume the trend tells us we're in a correction. This breakdown targets a move down to 18,100. We're currently trading right at 18,357, which is the 200-day moving average. That has defined the comp's major uptrend according to the 200-day moving average that originated in January of 2023. A decline underneath it, which our downside target here of 18,100 suggests is in the cards, that would equate to a major bearish trend change, which is a big problem. This chart on the bottom panel here is the corresponding relative performance chart of Comp versus the S&P 500. Comp or tech typically lead. Technology usually leads the broad market higher and lower. You can see that this line was going up here from basically the middle of October of last year up until about a month ago, indicating Comp was leading, the Nasdaq was leading, technology was leading. That is healthy for the market. When that changes and you lose your leadership from tech, oftentimes you're going to lose your broad market trend. That is what's happening here. As of February the 21st, Comp is now underperforming SPY or SPX on a 63-day basis, which is a quarterly basis. This is not a good sign for the market. The next one we're going to look at is NVIDIA, which was the star obviously last year, and it's run into some trouble. NVIDIA, by the way, has maintained a tight and stable positive linear correlation to the S&P 500 throughout the past 25 years. So as goes NVIDIA, so goes large cap tech, and so goes the S&P 500 according to statistics. So here's what we're looking at here. This is the 200-day moving average here, and this line, the NVIDIA first moved up above its 200-day moving average to indicate an emerging major uptrend in January of 2023. So that was 2 years ago. Look what's happening here. At the end of January, it dipped below the 200-day moving average. We had some new buying coming in, some people trying to buy the dip and get a bargain in NVIDIA, but it never really was able to get back above its 50-day moving average, which is here in blue. Orange is the 200-day. And now we're breaking back down underneath the 200-day moving average again. Not a good sign. Look what's happening in the relative performance department down here. This is NVIDIA on a relative performance basis versus the S&P 500, and this green line is the 63-day moving average. It's been under the 63-day moving average since January the 24th, meaning that for the past month and change, NVIDIA is underperforming the S&P 500. That is necessary leadership that we are starting to lose. As long as we stay underneath the 200-day moving average up top in NVIDIA, and as long as we keep underperforming the S&P 500 in NVIDIA, problems for the overall U.S. stock market. Let's go to our next chart. We're going to look at some volatility here via the VIX. The VIX is the CBOE Volatility Index, and here it is. So what I want to point out in this chart, we've got the VIX up top here with its 21-day moving average. Why the 21-day moving average for the VIX? 21 days is Asbury Research's tactical time frame. Our strategic time frame is 63 days. So here's the VIX here with the 21-day moving average, and we've got a little chart of the S&P 500 down on the bottom. This shows that every time the VIX has moved up above the 21-day moving average, we've had a decline in the S&P 500. Indicates the market is getting more fearful on a tactical basis, and it historically has pushed stock prices lower. Here's our most recent one here. The most recent time the VIX moved up to above the 21-day was on February the 21st, about a week or so ago, and look what's happened to the S&P. As long as the VIX stays up above the 21-day moving average, which right now is at 1670, the stock market is likely to remain under pressure. Let's look at some relative performance with our next chart, which is going to show us the relative performance of stocks versus bonds. So for this, we're using SPY versus AGG, which is the Aggregate Bond Index ETF. So here we've got the S&P 500 up top with its 50 and 200-day moving averages in blue and in orange. And down here, we've got the relative performance of SPY versus AGG. When SPY is outperforming AGG, or stocks are outperforming bonds, healthy for the market, indicates a healthy environment for the stock market like we had here. The S&P 500 was higher throughout this whole period. Back in August and September of last year, when you recall the S&P was struggling to make new highs, we had SPY underperforming AG right here, and both of those took the market down. Look what's happening now. Since February the 21st, SPY is underperforming AG by a significant amount. As long as this line stays below that 63-day moving average, it means that stocks are underperforming the bond market, and that is historically negative for stocks overall. So I'm showing you a lot of negative stuff here. Let me show you one thing that is potentially positive. And it's probably the least important of all the stuff I'm showing you today, but seasonality. This is seasonality in the S&P 500 going back 20 years. And you can see that March and April are stronger than February, which is right here. February, March, and April. April, going back 20 years, is the strongest month of the year. So to me, seasonality is not the trend. It's either a headwind or a tailwind. The trend right now is suggesting more tactical weakness in the stock market. Maybe that can turn into strategic weakness, but seasonality is in our favor. Is that something that's going to get me all bullish? Not at all, but I'm trying to show you all sides, and this particular metric is the little bit of good news that I can see right now. The last chart we're going to look at has to do with bonds, actually bond yield. So this is not directly influential to the S&P 500. The linear correlation between 10-year bond yields and the S&P 500 has been non-existent for years. There's no statistical significance there, but we know bigger picture, higher yields often mean the stock market's going to struggle a little bit more to be able to perform in a higher yield environment. And when yields are lower, they're better for stocks to go higher. But this is what I wanted to show you. Not so much what the next direction is going to be, but rather this big inflection point that we're at. This is TNX, which is the CBOE 10-year Treasury note index. It's a blend. It's an index that's comprised of a number of 10-year notes with various maturities. And you can see this is a very good index just for the overall bond market. You can see this big trend line from the peak that we made up around 5% here at the end of 2023. Huge trend line here, and the 200-day moving average is right around a 430 to 425 yield. We have been testing that for the past 3 days. If we can't hold that, we're likely to continue dropping in yield, and the next big level is down here at about 360. If we hold here and rebound, we could very well end up taking another run at the 5% area over the next couple of quarters. But keep an eye on this 430 to 425 level because it's super important right now. So going back to AsburyResearch.com, just overviewing, benchmark S&P 500 is in the midst of a tactical correction that had been in effect for the past week, according to the Asbury 6, and has recently broken its 2023 major uptrend line. Meanwhile, the Nasdaq comp is testing major support at 18,357, but we've got a lower target because of a bearish chart pattern. NVIDIA breaking down below its 200-day moving average and underperforming the S&P 500 for the past month. A lot of negative stuff here. We can also see weakness in stocks relative to bonds and rising volatility. Watch these major support levels we talked about today. If they can't hold, which is the way our internal metrics are setting up, recent market weakness can be just the beginning of a much deeper and a lot faster decline. Now, finally, just a little bit about my firm, if I may, Asbury Research. We offer 2 tiers of investment research for professional and also retail investors. So we're working with both retail and also with professional people. We have a premium research product that includes all of our models, all of our model portfolios, which you can get information about right up here. And we also have a free letter on Substack. So you can go to Substack and find that. We also offer asset management that includes 4 different model portfolios and all the models we see here. You can connect with us via the contact tab right here at AsburyResearch.com. Hope you found our ideas and all of our latest analysis helpful and useful. This is a really tricky time in the market, and it's really a good time to pay attention. We will see you at my next video for our friends at Stockcharts in probably about a month. Thanks for watching.